At Metropol TVKE across all your social media platforms. 20146 your SMS line. My name is Simba Elijah Charles Kiage. Hashtag you're supposed to use this morning is Business AM. Let's talk about the biggest economic headlines that you're closing your week with. Well, business conditions in Kenya's private sector economy continued to improve in February, according to the latest survey data in the Stanbic Purchasing Manager Index. However, the rate of expansion slowed to the weakest for 8 months. Output rose only marginally amid a more modest increase in new order volumes, as businesses reported that a weak cash flow limited households and client spending. Purchase prices rose steeply, led by a hike in value-added tax at the start of the year. Now, the headline index dropped by 50.9 in February, down from 53.2 in January, and signaling the weakest rate of improvement in the current 8-month run of expansion, following the initial impact of the coronavirus disease in Now, slower sales growth was often related by panelists to lack of cash flow in some parts of the economy, leading to reduced customer spending and travel. Business expectations for the year ahead dipped slightly in February, but remained above the level seen through the second half of 2020. About a third of surveyed firms expect output to rise, linked to plans for expansion and increased marketing activity. Good, just before we cross over to the panel that we have for you this morning to help us go through some of these headlines, let's look therefore at what has been the credit trend to the private sector. So we talk about whether indeed we've seen it really grow, and we can actually see that, look at it, that all the way up to Q3 and Q4 of 2020, it has been on a rising trend. But the conversation there, it is rising, but albeit not meeting the levels that I expected. I'm talking about the double-digit figures. Well, let's look at what has been also the performance of the economy within the spirit that we're talking about, the resumption of business in the economy. All right, let's look at that quarter by quarter GDP growth rate in the economy, and exactly that's where we're coming from. In fact, we are coming from that recession, and I want to look at those 2020 figures, and we're waiting for Q4 figures as well. That's exactly where it is that we're coming from when it comes to the growth of the economy. That indeed, that's how much businesses were affected during this time for the coronavirus pandemic. All right, let me therefore introduce the panel that we have for you this morning. We have George Mungam, the managing partner, AMG Kenya, and Robert Ochieng, who's the CEO, Abojani Investment. George, let me begin with you therefore. Do we expect to see this continued growth of business activity for the entire of 2021?
Thank you, Elijah, for that brief. 2020 was a tough year, Elijah, and as we had predicted, things didn't go very well. Remember, we are coming from a backdrop of a growth rate of 5.7% in 2019. And then 2020, Corona happened, and the growth is likely to be between 1.5 and 2%. That should be the slowest growth rate that Kenya has experienced, probably in the last decade. But that, if you compare that with our peers in Africa, then probably we did much better. That notwithstanding, 2021 has come up with at least some light, if you look at it that way. Remember, we are getting our first batch of the COVID-19 vaccines that landed on Tuesday, and therefore we expect business to respond positively to this. And already we are seeing good pointers towards that. Remember, between Q3 and February of this year, credit advance to the private sector has increased almost by a double digit, albeit with a rider that some of the non-performing loans have also increased by almost double digit. But that notwithstanding, Elijah, we've seen a lot of activity, especially in the education sector, Remember, the education sector was one of the sectors that went down completely. But come January 2021, things have improved quite greatly, with schools resuming operations. So we expect this to continue in the next quarter, that is quarter 2 and quarter 3, and even quarter 4 of this year. Hospitality has not done very well, Elijah, so far,
Yes.
but we expect that as the vaccine comes into the country, and as countries around the world vaccinate or inoculate their populations, then you are going to see a rebound of the hospitality economic sector. So, in a nutshell, Elijah, 2020 was a bad year for almost all countries across the world. 2021 is coming coming in with a lot of opportunities, a lot of growth prospects, and a lot of optimism from an economic perspective. We expect we expect education to continue growing. We expect hospitality or tourism to start going growing in quarter 3 or quarter 4 of this year. Manufacturing has already picked up quite well, Elijah. If you look at manufacturing companies across our economy, that is, you look at EABL and the likes. Telecoms didn't do very badly last year, and we expect them to do even better this year. Logistics is going to be a very big contributor to the economic rebound of our economy this year, and therefore players in the logistics space should gear up for better prospects this year. So, Elijah, from a growth rate of 1.5%, though we have not, Central Bank has not given us the figures yet, but we expect that it will be between 1.5 and 2% GDP growth 2020. We are likely to see a growth rate of between 3%, 4% in 2021. So this is a year of rebound. This is a year of picking up where we left last year, and start pushing in the economy, and seeing that we at least bring back what we lost in 2020, Elijah.
Let me bring in Robert at this point as well. Robert, I mean, well, you can see exactly what George is saying, that, well, 2021 is going to be a rebound year. It's going to be the year that things are bound to correct. But then it's still 2021, and we're just a couple of days, to be exact, 12 days, or 9 days actually, shy of a year since we went into curfew. Do you think that the curfew limitations and restrictions right now are also going to affect the way in which businesses are going to rebound in 2021?
Thank you very much, Elijah, for having me. So I think just to add on to what George has shared,
yes,
of course, we know that the education sector is now back on, and this year they're going to have 4 terms. So that is positive for that industry, because it is said that the tuition fees paid for the private sector alone is about 50 billion Kenya shillings. So hopefully, if that can come into the economy, then somehow it is going to find its way into so many pockets, and that will fuel part of the growth. Then we're also seeing the services industry rebounding, because most companies now, they're tending to go towards the service sector, especially ICT. So that's also an area that we are likely to see growth, with many boards and senior management doing budgets to go into digital transformation, because we saw that when the world was down, it is technology that was moving everything. So even SMEs, they're trying to find out if they can create a website, a portal, and have delivery people do that. So like gig economy is also likely to grow, as people now just want to find ways of creating values with limited capital. So that means that that gig economy is likely to grow, whereby you get an opportunity to do a contract or do some work for 2 hours rather than being employed full-time, because most companies, they're on a shortfall in terms of their budgetary allocations. So we've also seen something quite exciting from Safaricom. So today, their book closure for a dividend of 18 billion Kenya shillings. And of course, that part of it will get into the pockets of the government and institutions and retail investors. So that's something positive, because 18 billion is quite something. And for BAT, the results came in very well. So I think they've made a faster recovery than EABL for obvious reasons, because you know that for EABLs, they're still going to be affected by the night curfew. And unfortunately, that's also still affecting the hospitality sector, like just shared, and it is also affecting like public transport. Yeah, it is affecting them. So hopefully there can be some positive news from that segment. Generally, we are still seeing some companies and that even blue chips like Britam, they are going to lay off a few staff. So that again is not a good sign. So if we can find a way of growing the informal sector faster, because we need people to be back to jobs. There might be insecurity concerns and other things. If people are not producing, then our GDP obviously relies on production. So that's a sector to look at. So I think the recovery will be positive, but we still need to work on the curfew and maybe find ways to like build the informal sector so that those who lost their jobs, at least they can find something to keep them going. So that's a very big concern. So if you look at the statistics on unemployment rates, they're still quite high there. So,
Yes.
so that's something that we need to look at here.
All right, Robert, just before I bring in George this morning as well, I mean, somebody's going to ask you, how do you think now the banks view the private sector within the country? If you look, well, the numbers are really good. If you look at that data for credit growth in the private sector, I don't think if we can show it right now. I mean, it shows that all the way up to Q4, it has been increasing. But how do you think they view the smaller businesses in the private sector right now in 2021? Do they still view them as volatile and highly risky in this rebound stage?
So I think the approach that banks are taking is that they are cautiously optimistic.
Yes.
Optimistic. So obviously they are tightening their loan appraisal processes. And just yesterday, we've already seen some positive sentiments from Equity. They're getting funding to fund SMEs. I think COP also got the same. And a very, very positive news from Equity again is that they're going to extend the loan moratorium for some organizations that have loans with them up to 3 years. So I think that will give the SMEs some breather, because at least if it is extended, you'll keep the little cash that you have and try to build your business.
Yes.
So I think we're on a positive trajectory.
Pretty much. George, let me bring you in on that question as well. How do you think now the lenders view the private sector? And I'm talking about the smaller businesses that actually contribute the larger part of the economy. Do we still have the same view of this sector like we did in 2020? George, unmute your microphone, please.
Sorry, Elijah. Sorry. I hope you're getting me now.
Yes, we can get you now.
I want to surprise you that the COVID season, smaller businesses survived better than the larger businesses, Elijah. If you look at the hospitality industry, the smaller hotels or the smaller concerns survived better than the larger hotels. You realize that last year, Radisson Blu, I think, suspended the operations. Hotel 680 suspended the operations. Intercon suspended the operations. But the smaller concerns at least survived the season. And that is why you see several lenders focusing more on the smaller businesses as opposed to the corporates. You've seen what Equity Bank is doing in the SME space. You've seen what Cooperative Bank and even Barclays, that is Absa Bank are doing on the SME space. And therefore, probably the economic rebound that we're expecting in 2021 will come more from the SME subsector other than the corporate subsector, so to speak. So yes. I think that is the sector that the government should focus more on, and even the lender should focus more on. Because remember, this is a sector that employs the bulk of our population, and if it can get back to growth, the better for us, meaning that they'll be able to pick more into the employment bracket as opposed to the corporate. So Elijah, I think that The SME subsector is a subsector to look at this year if we were to revive our economic growth for 2021. They are going to contribute significantly to our economic growth in 2021, Elijah.
Pretty much. All right, gentlemen, I'd like us to move on to the next issue for discussion this morning. Now, the Digital Lenders Association of Kenya has welcomed proposed legislation aimed at regulating players in the digital lending market. Kevin Mutiso, the CEO of DILAC, that's the Digital Lenders Association of Kenya, has said legislation will rein in on rogue industry players, thus de-risking it, meaning digital lenders will be able to get cheaper and more capital, thus improving pricing at which loans are offered at. He however warns that legislators should be careful not to over-regulate the market and tamper with key factors such as pricing of loans, failure to which the country may experience the consequences of interest rate capping. His comments come days after the National Assembly gave its nod for review and debate on the proposed Central Bank of Kenya Amendment Bill of 2020, which will enable CBK to supervise and license digital lenders in Kenya. The bill is now before the National Assembly's Committee on Finance and National Planning, where Kenyans and other stakeholders will be invited to give their views before it's taken back to the House for debate and vote. CBK currently regulates banks and microfinance institutions. Just before we cross over to the data that we have for you this morning in this space, let's listen in to Kevin Mutiso, the CEO DILAC, on his comments on the forthcoming regulation.
I think we need to remember that Kenya is a free market economy, and free markets are the most beautiful thing ever invented. And the moment you start tampering with price, you know who suffers? The customer. So if the customer is, if the Legislative Assembly continues pushing the narrative that pricing caps is what the market needs, what they've done is they've basically taken away the ability of that consumer that they think they're protecting from accessing finance.
That's him. He's saying that, well, we should not cap. We should just regulate and take out rogue players. Let me bring in you, Robert. Do you think, because there's a question that, well, regulation could mean capping the rates for digital lenders?
Elijah, let me go fast.
Yes, George.
Regulation of the digital lending space is long overdue. If you were to ask me,
yes.
Remember, the monetary subsector or our monetary subsector is a very critical sector in our economy. If it is not managed properly, then you find you get a ripple effect or a multiplier effect in the economy. If it is managed well, then you get the multiplier effect again in the economy. So I think the digital lending space is something that we cannot run away from. A big percentage of Kenyans, in fact, statistics say that more than 70% of Kenyans in the adult population have interacted once or twice with one or two of the digital lenders. So that's a very big market segment that we cannot ignore. There's been risks that has come with this digital lending space. And remember, these digital lenders are supported by shareholders behind them. They're supported by several stakeholders behind them. And therefore, if they were to lose money, or if they were we were to have rogue players in that subsector, then we have so many people losing from that space. So Central Bank of Kenya coming in, or Central Bank of Kenya being proposed to try and regulate this subsector, I think is a welcome move, so that we can weed out the rogue players and retain the genuine players in that subsector. That's a subsector that is likely to experience a lot of economic growth in the next 3, 4, or 5 years. I would not be comfortable with the Central Bank of Kenya putting in a rate cap for the digital lenders.
But George, George, I'm sorry to cut you short. I don't mean to. But then, I mean, we're coming from a regulation that says well, that you have to look at the operations of these lenders, where they get their money from, how they come up with the products, how they price their products, especially on the pricing of the products. Can you talk about regulation that doesn't look into the pricing of a product?
So, Elijah, can I take that?
Yes, please. As
Yes,
we wait for George to
yes.
come back,
Yes.
Robert.
Yeah, let me take that. Yeah, so basically,
my colleague can pick up that.
yeah, so basically, if you look at innovation, the key thing about microloans is that they bring in the aspect of accessibility, which is very, very key.
Yes.
And we've seen that since the introduction of M-Pesa and even what Equity Bank did, what the most important thing that they are doing is accessibility. Because most structured organizations, they tend to have what we call hard loan appraisal processes, which make it very difficult for most people to access loans. So these digital lenders, they bring in the aspect of pricing risk, and there is models. So these models, they look at the inputs and then the outputs, and then they try to determine how these lenders can still be profitable. So I think it is very important that as you look into it, we work with the players and we try to use a data approach, because we saw the KCB CEO said that even for KCB M-Pesa, for them to be profitable, non-performing loans have to stand at 3% or less. So just look at that. So it's a bit tight, and therefore we need to look at it from a data point of view and support the players. Of course, the bad guys will always be there, whether it is in banking or any other sector, and that's why you have regulations, just to ensure that people are complying with the agreed principles, like not interfering with privacy. If I'm your friend and I take a loan, someone else should not be told that Robert took some debt. That's just wrong, and it doesn't work here in Kenya. Maybe it has worked in other markets. So it's also important to put into context the principles that Kenya used to run their country. So you can't bring something that is happening in China here in Kenya. But in terms of pricing, I think it should be flexible, because models are flexible, and that's why even for the traditional banks, we are looking at risk-based pricing, and it's a work in progress. There's no silver bullet to say that this model will work or not. That's not how it works with machine learning and AI. So it should be flexible and work together.
Yes, George, let me bring you in on this as well, gentlemen, just before we go on break. I mean, George, the definition of rogue is when you look at the regulated versus the unregulated. If you look at the regulated, George, we're talking about an annualized interest rate of around, what, 11.85%, the lowest it's ever been. And the man seated up there is saying, well, this is very comfortable. George, is it possible to say, well, if you're under the Banking Act, then you have to conform to the interest rates charged under the Act? Is it possible for you to say that? That's why I'm asking you, can you say rogue without looking at what we've seen in the economy so far? Some of them charging an annualized interest rate of what? More than 500%, 300%. Is that no rogue? And so when you're saying rogue, aren't you saying that regulation should also give CBK the ability to cap the pricing? George, can you get me, sir?
I agree with you, Elijah, that some of those lenders, I can get you. Are you getting me? Okay. I agree with you when you say some of these lenders are charge exorbitant interest rates. In fact, some of them go up to all the way to 96%, and therefore you cannot differentiate them with the traditional Shylocks. But that notwithstanding, I think what the government, what central bank did with the commercial banks in the last 3 years can give us an indication on how you can manage interest rates in such a way that you give an indication of where the interest rate should be, but still you don't cap that interest rate at particular level. Remember when the interest rate capping bill came into effect, the central bank determined how much you can charge at any given time. But when that was repealed, then we came to a regime where central bank just gives a pointer of where the interest rates should be, and commercial banks are allowed a leeway or a headroom to charge plus or minus 2, 3, or 4%, depending on their risk profile. So I think that can work with the digital lenders, such that central bank just gives an indication that your interest rate should be around this level. You are allowed to charge plus or minus 5%, depending on the risk profile of the client you are you are dealing with. But as it is today, Elijah, the interest rates that some of these digital lenders are charging are way up there, and it might not be sustainable. So if you look at the entire ecosystem, then central bank can be able to gauge and see what are the reasonable interest rates to charge. Central bank will look at their source of capital. That is what central bank does with commercial banks, how they apply that capital and how they manage their risks in order to be able to return an income back to the shareholders, but also put a positive impact into the economy. So I think it is a very dynamic environment that central bank will have to look at almost on a monthly basis before they finally fine tune what they want to offer into the market. But it is an industry that is going nowhere. That is an industry that is likely to be here with us, and it's an industry that is likely to attract quite some capital, and that is a good thing for the economy. Remember, we rely on FDIs for our FX reserves, and if you can attract capital through that avenue, then why not, Elijah?
All right, Robert, once we come from the break, and I want us to look at this data just before we step out, let's look at mobile annual average transactions for the entire over 2020, which if you can actually show us that data, I'm talking about transactions, not registered mobile money accounts, the second data point that you have on that as well. I think we'll get it after we come from this break. We're going to look at it and then analyze exactly how that trend, therefore, would force any regulation or the regulator to actually say that probably when we're talking about regulation, it should begin from the interest rates and probably end at interest rates. Therefore, asking the question, if you cap the rates, are you going to force discipline among the digital lenders once we come from this break?